Well, determining whether your farm activity is a trade or a business, it is an important issue for the IRS. And while the answer is typically clear, there is confusion. It can arise, leading to tax deduction issues. Well, the man to straighten all this out for us, Roger McEowen with the Washburn School of Law, for a closer look. Roger, always a pleasure to have you here. So let's start by talking about why this is such an important issue.
Well, Suzanne, good to be with you. It is one of the big issues facing taxpayers in general, but farmers in particular, particularly when you retire. Are you still engaged in a trade or business of farming, or are you engaged in a rental activity? If you're just renting out your land on a cash basis, that's not a farming activity. You can't get certain deductions associated with being in a trade or business because IRS thinks you're engaged in a rental activity and you're not. Now, the upside of it is if I'm not engaged in a trade or business activity, my income is not subject to self-employment tax. If I am, it is also subject to self-employment tax if I'm a self-employed farmer, for instance. But being in a trade or business means I get more business-related deductions. If I'm not in a trade or business, I'm not going to get those.
I understand you know of a key court case that is involved in this issue, the trade or business. Tell us a little bit about this.
Yeah, this is actually a U.S. Supreme Court case in the late 1980s, and the taxpayer was a gambler. And of course, if you're a gambler, you can offset your winnings with your losses. But if you're a professional gambler, if you're in the trade or business activity of gambling, then all of your losses are deductible as business expenses. And that was the question. And coming out of that case is the principle that whether you're engaged in a trade or business is dependent upon all the facts and circumstances. It doesn't matter whether you signed a particular contract, whether your name's on a contract or whatever. We're going to look at all the facts and circumstances, and on the whole, are you engaged in a trade or business activity, or are you passive and not engaged in a trade or business activity?
I want to switch gears right now. Income tax basis, key concept that can have a big impact on farm income. Talk about how that's determined and some of the main elements farmers really need to keep in mind here.
Well, basis is determined depending on how you acquired the property. If you bought the property, we start with purchase price as your beginning basis on that property. Then there are adjustments to that basis over your period of ownership. If you add improvements to the property, you're going to increase your basis. If you claim depreciation, then you're going to decrease your basis accordingly. That's one way to acquire a basis. Another one is you could have property gifted to you, and in that instance, you're going to get the donor's basis that's going to carry over into your hands. If you receive the property by inheritance, then you're going to get that fair market value basis step up equal to the value at date of death in your hands. And that's really the big one that's important to agriculture, is maintaining that stepped up basis at death. If tax laws were to change, we want to make sure that we keep that in place, because there are a lot of low basis assets in agriculture, and we get a chance to step up that basis by inheriting those assets and then run it through the tax mill again.
Well, before we go, small farms and businesses, they are closely watching the future of the 2017 tax cuts with particular attention on the pass-through tax break. Any advice, producers, here in this situation?
Well, watch the timeline on this. We just had the Senate late last week that passed the framework that the House had passed. So now we've got a framework to go forward to continue the Tax Cuts and Jobs Act of 2017, or even make it permanent, plus bring in President Trump's other tax initiatives that he wants in his tax proposals. The pass-through deduction is one of those big ones. If you're not in a C corporation, a lot of our farmers are not, then you get that 20% qualified business income deduction. That is set to expire at the end of this year. And that's a big deal. That can take my, let's say if I'm an effective tax, or my tax rate is 24%, I knock off 20% of that, and I'm basically have an effective tax rate on my farm income under 20%. I want to make sure we keep that. And of course, on the corporate side of things, you could get a corporate tax rate of right around 15% for producing crops and livestock in the United States if the president gets his wishes in this tax bill.
Always great information. So glad you're the man breaking it down for us. Good stuff, as always. They can log on to your website, find out information, and also on ours, correct?
That's correct, on both.
RFD-TV.com. Roger McEowen with the Washburn School of Law, always a pleasure.